Hello everyone, welcome to Just Invest Today. And today we have a good video. We're going to be talking about the income statement and three things to look for when you're looking at the income statement. So the income statement is going to be the first thing you guys look at. Remember, we want to find businesses with a competitive advantage. We don't want a mediocre business that's kind of here and there, because when you find these price competitive businesses, we can't depend on them to make money in the long term. So we gotta find businesses with a competitive advantage. So in this part one of this video, we're gonna find out what we can look for in the income statement to find these companies. The income statement basically tells us the results of the company's operations. This can be covered over quarterly or annually. And when we're looking at the income statement, there's three things that we need to know about the income statement. It tells us about the revenues, the sales of the company that you're looking at, the expenses, stuff I had to put in to generate those sales, and the profit of the company. How much profit did it generate from those sales? So the revenue is the first line on the income statement. And this is an important number, but it's not the end all be all, because I see a lot of people looking at the income statement and seeing it's growing phenomenally, like it's growing 10%, 15%, 20%, but that doesn't tell us everything about the story of the company. We want to know how much net earnings is it generating, how much profit, because just because the revenues are growing or it looks good that like there's a lot of revenues does not mean the company is profitable, right? Because the company has to pay out expenses for the companies to generate that profit. So we got to make sure that when we're looking at companies, we're not just staring at the revenue seeing that it's growing, because we need to make a profit on that revenue, which is very key in finding companies with a competitive advantage. So one of the first things that we want to look at is the gross profit of the company and those margins. So when we're looking at that gross profit and the margins of the company, we can see how efficient the business is at generating a profit. When we're looking at these companies, we want to see 40% or higher on the high standards, because that's going to show us that the company has a competitive advantage. When we see gross profit at like 20% or lower, that shows us that it's in a price competitive business and we don't have that solid ground for a competitive advantage in the company. So we don't know if this company is going to be able to last in the long run, 5, 10 years from now. So when you minus the cost of goods sold from the revenue, we get the profit. But then when we look at gross profit margins, we take that gross profit and then we got to divide it by the revenue of the company. And that's going to give us our profit margins. So make sure when you're looking at a company, we get that 40 or above profit margins. It shows a very nice competitive advantage in that company. 20% or lower, it's kind of being an iffy business, so it's going to be price competitive, and you don't know in the long run if that company is going to succeed. And then in the middle, it's kind of a gray area, and that's what you kind of got to watch out for. And maybe those companies in that gray area, around 30%, can still be competitive companies, but we want sure bets of companies that are going to be solid going in the future. When we look at numbers on these income statements, one of the key things to find durable companies is the consistency of these numbers. We don't want gross profit all over the place from 20 to 40 to 30 to 10. That's not consistent. So when you're looking at consistency for gross profit, we want always a 40 and above, like 42, 43, 41, 40, maybe 39. Like we want consistency. We don't want to see companies with gross profits all over the place. And remember, 40 and above is all good. It's going to tell us, it's going to give us a hint of a business with a competitive advantage. Even though this is not the end all be all, it's not the only number that we look at. The second number we're going to look at is the net income of the company. So the net income is basically the revenue minus all the expenses and all the taxes, and that's going to give us our net earnings of the company. When we're looking at the net income of the company, again, we want that consistent upward trend of numbers. So we want a year over year, 10% or better year over year, and we got to go back. So when you're looking at the 10Ks, go back 5, 10 years and see if that net income has been going up steadily, because that's very important. We want consistent numbers going up. So when we're looking for a company with a competitive advantage, we want to find these companies with a higher percentage of net earnings to total revenue. Think about it, guys. What kind of company would you rather have? A company making $2 billion of net earnings to $10 billion of revenue? Or would you rather have the company making $5 billion of net earnings to $100 billion of revenue? What company would you rather have? The company that has a higher total net earnings to revenue is going to have a stronger underlying economics. The company that had $2 billion of net earnings compared to its $10 billion of revenue is generating 20% margin, while the other company that had $5 billion of net earnings to $100 billion of revenue has only a 5% of net earnings percentage. A simple rule when it comes to this is companies generating 20% of their total earnings on their revenue has a strong competitive advantage. Company earning 10% or less is dealing with a price competitive industry, which you kind of don't know what it's going to do in the long run. And then there's the gray area in between the 10 to 20%, which is companies that are probably on the way to becoming those higher grossing companies, but we don't know. And those companies could be long-term strong companies in the future, but they're not the sure bet yet. So the last thing we want to see when we're looking at the income statement is the earnings per share. You got to divide the net income by the shares outstanding. And this is important for us because we want to see an upward trend of numbers. We want that consistency again. We want that EPS to be growing year after year after year after year. And we don't want to see a downward trend of these numbers or numbers just going all over the place. Because when we have a strong EPS, that means the underlying economics of the business are usually strong too. So the company is either buying back shares, which means that has a strong cash position, it's a very strong company, or the company is just gaining market share, which means it's a strong company as well. So we're looking for that EPS to be consistent and not all over the place. So this is just part one of the income statement. I'm going to release part two. But guys, please like this video, subscribe to my channel, and I'll get back to you in the next video. Peace.